Good morning, everybody. Jason Bowman here, and as you can see, I am doing something brand new. I am on camera. As much as I am uncomfortable with that, it's something that I'm trying to force myself to do more of, and so hopefully you don't see too much in the way of spittle and whatnot flying from my mouth when I get outraged at the IRS. All right. All right, welcome everybody. Jason Bowman here, and welcome to our third and final episode of IRS Collections Representation Level 2. Today, we are specifically talking about tax liens. Dun, dun, dun. Specifically, we'll talk about the statutory basis for tax liens. We'll talk about the differences between withdrawal and release, and we'll talk about how to get withdrawals and when to apply subordination and discharge processes. So if that is what you are here to learn about, you are in the right place. I'm joined today once again by Mr. Dan Henn. How's it going out there, Dan?
Good. Great to see everybody. Well, I should say see you, Jason, but I'm glad everybody's out there and ready to learn about this great topic.
Sweet. And you know, it was we were actually just talking about this before we went live in our members only Facebook group this morning. Somebody actually posted a question directly related to the topic, and I was like, how timely. So we actually will be talking about exactly what Renee brought up, and I'm hoping that she is able to join us today. I don't see her on the attendee list, but we will be talking about a topic. It's probably the most common application, actually, of this entire topic, and that has to do with subordinations in relation to real estate transactions, okay? Particularly cash out refinancing. So we will be directly addressing that today. So let us get into the slides here. And just so you know, there is a new, I added a lot of slides this morning as I was going through the presentation. I actually added quite a bit of material. So the slides that I emailed out are obsolete, even though I just set them an hour ago. So in the handouts pane of GoToWebinar control panel, which for me is over there somewhere, the new handouts are in there, okay, and they're about twice as long. So you'll notice that. So snag those from the handouts pane. So our objectives today are to be able to explain the difference between lien withdrawal and release. That is a very frequently misunderstood differentiation. We're also going to make sure that you understand the conditions for lien withdrawal, understand the process for lien withdrawal, and know how and when to utilize subordination and discharge processes. We're also going to have a discussion. This is one of the things I added. I want to have a discussion, get you guys engaged a little bit, about we'll just run some quick scenarios, okay, and have some discussion about those before we sign off. So, and I'm also, you're going to start seeing me do this more and more at the beginning of these webinars, because there's some of these topics that practitioners, and especially if we're doing a live event, where either your eyes glaze over or, you know, people do the, you know, that thing, and you know, in a live seminar, we can see that. But I can imagine that there's some of you sitting at home or in your office that on some of these topics are maybe reacting the same way. So I want to start talking at the beginning of each of these sessions about why you should care about this particular topic. Dan, you remember I started doing this with the installment agreements because so many people came in thinking that tax resolution equals offer and compromise, not realizing that the vast majority of your cases are going to end up on a payment plan. That's why you need to know about installment agreements you can go your entire tax resolution career without ever doing an offer in compromise, okay? But you can't go your career without doing a payment plan, okay? So this is why you should care about this. And Dan, I'll be asking you here in about 1 minute what your thoughts are on these. So be prepared for that, just to put you on the spot.
Sure.
So, you know, lien work, as I call it, and when I say lien work, what I'm talking about is obtaining lien withdrawals, releases, discharges, subordinations, right? That's lien work. And I just lump it all together and use that phrase. So lien work will be central to somewhere between 5 and 10% of your case resolutions. There are situations, and we will talk about this during the withdrawal portion of the program, where you use the lien work in order to facilitate collection. So a big part of what you do is to demonstrate that the withdrawal, release, discharge of an asset, or subordination of the tax lien will, in the long run, net the IRS more cash. Okay, that's what we mean by facilitate collection. Melissa, I do not know if there is a way to turn down the volume from the control panel. Check the preferences maybe and go to webinar.
Yeah, if you go to preferences, audio, there's a little bar there. I think that might help control it a little bit.
Okay, thanks, Dan.
I don't know if it does it much, but check that out.
I don't know. So, yeah, these processes are to help ultimately facilitate collection, okay? So the IRS has these procedures in place for their benefit. Trust me, it's not for the taxpayer's benefit, okay? But a lot of times we can use these procedures in order to create our resolution and get the IRS paid and get them out of our client's life, okay? I also mentioned the real estate side. Pretty much any real estate transaction in which a tax lien is involved is going to require the assistance of us, okay? And we can't really get into marketing on these CE presentations, but I will tell you real quick, this is a tremendous referral marketing opportunity for you to build relationships with title company reps, mortgage brokers, and real estate agents, okay? Anybody involved in the transaction that will see, oh, there's a tax lien, okay? Or there is actually an entire business model for tax resolution where you don't do any of the other stuff. No payment plans, no offers, no penalty abatements. You can actually run your entire business doing lien work only. There's enough of that out there. And it's also incredibly cheap marketing. It's time consuming, but it's cheap because all you're doing is networking and building relationships, and you're building a strictly referral business. Okay, I know people that are doing lien work only in their tax resolution practice. Okay, and this is also important because everything, literally everything, minus about $6,000 in statutory exemptions, all taxpayer assets are subject to the lien. Okay, so anything that the taxpayer owns or has a future right to, such as future income, is actually owned by the IRS, and the IRS has to give you permission to finance, put another lien in place on that asset or to sell that asset, okay? You have to ask for Uncle Sam's permission, okay? So these are the reasons why you should care about this process. Dan, do you have any thoughts on this? Anything you'd like to add?
Well, yeah. I mean, I think the thing that you had mentioned was, especially your second bullet point there, in a real estate transactions, and that's one of the reasons why I like to work with the realtors. They can be good tax resolution clients themselves, but they are directly connected to people who have these issues, and they know about them and need to deal with them before they can go to closing. So That's why it's important to think. You got to think of people differently, and who do they touch, and who are they, how can you connect to them? Like, you've always mentioned about having a bankruptcy attorney in your back pocket for referral sources. So, it's that kind of a thing. And when you're dealing with the types of cases that we generally get, they're big dollars that usually have a lien filed. And I know you'll get to it later, but like Renee's question was, I got a guy who needs that, buy a property, and you'll go into that later as why that would be a benefit. But how do you get the lien removed, subordinated, withdrawn, whatever the thing that works for that? So those are the types of issues that are out there. And like you said, there are many people that we know or have seen that they just do this type of work, or predominantly this type of work, and make a good living at it.
Yeah, absolutely. Thanks for your input on that. And I want everybody to think about this from the perspective of their own practice, right? And see how this could help you level up in some ways. So it is time for our first polling question. I do have some new stupid dad jokes, but you're going to get tired of these dad jokes after the next 2 or 3 months, I'm sure. So what does a clown say when you hold the door open for her? Stop clowning around. Honk, honk. Thank you for the nice gesture.
It's hard for me to comment on them.
I'm sure it is. Oops.
Yeah, now anytime I hear a joke like that, I instantly think of you. I don't know if you heard the Selena Gomez 73 questions video she did.
No.
What did the 80-year-old say to the pirate? Hi there, I'm 80.
Oh boy.
Something like that. I think I flubbed the whole thing up, but he did that corny joke.
Oy vey.
And I instantly thought of you.
Aw, thank you. All right. Let's talk about Robin says, how sad. Let's talk about the statutory origin of liens. So for a lot of these presentations, I only give this one like once or twice a year. So actually at 7 o'clock this morning, I was re-listening to my own presentation of this from a year and a half ago in outside of Baltimore when we did this. And that seminar got way sidetracked by a conversation about this, the statutory origin of a lien and what it attaches to. Do you remember that, Dan? Just how off topic we got because of this?
Yeah, well, I've listened to that a few times since then myself, but yes, because, what is, most people think of what a lien is. Well, it's the paper filing of the lien. That's
right.
What everybody thinks of it.
Exactly.
And so we got into a discussion, and again, I'm sure you're going to talk about it, but what really is, when is the lien actually filed?
Yeah, and I prefer to pull my material out of the Internal Revenue Manual instead of the Internal Revenue Code, but this is something where I think it was in this case it's worth referencing directly to the statutes. So this is Section 6321 of the IRC, which states if any person liable to pay any tax neglects or refuses to pay the same after demand, the amount including any interest, additional amount in addition to tax or assessable penalty, together with any costs that may accrue in addition thereto, such as collection costs that are passed on, shall be a lien in favor of the United States upon all property and rights to property, whether real property or personal property belonging to such person. And don't forget that elsewhere in the IRC, it defines person as businesses, corporations, other entities as well, and that's obviously been upheld by the Supreme Court as well, much to many people's chagrin. So the key here is the rights to property. This is the part that I think people misunderstand the most, okay? So if you have a right to property, so let's say that you have worked your 40-hour work week and you have a right to be paid. You have a legal right to be paid for your work, right, at your employer. They're required by law to pay you. You have a right to that money, and money is property. So that future paycheck is technically subject to the lien. That is why paychecks are a leviable asset, okay? Because it is a right to future property that you have. And when that actually materializes, the IRS can swoop in and take that property, you know, in the form of a wage garnishment, okay? So if what's another good example here? If you, let's say that you have a car that you have some contractual thing going on, maybe with a family member or something like that. Maybe you've been making payments of $100 a month to go towards a car that you're buying from your brother, okay? But you don't have the car yet, but you have the right to acquire the car. Guess what? That right is subject to this lien, all right? Now also notice that there's nothing in here about timing, okay? So then we go to the very next section of the code, all right, that talks about the timing, which states, unless another date is specifically fixed by law, the lien imposed by the prior section shall arise at the time the assessment is made, okay? And shall continue until the liability or a judgment is satisfied or becomes unenforceable by reason of lapse of time, which means the collection statute expiration date, okay? So the point here is that what some people refer to it as the secret lien, okay? It's not secret, it's right here in the code, okay? I think silent lien might be another term people use. I use the term statutory lien because that's what it is, okay? It arises the moment that they process a tax return or do an SFR, or, you know, after the appeals time on a statutory notice of deficiency after a examination expires, okay? Once the assessment is fixed, from that date, there's a lien, okay, in the interest of the United States government, okay? The lien does not arise after the 10-day period of notice and demand, after the 21-day letter, after, you know, anything else. It arises at the moment of the assessment, okay? And that's a very important point. So federal tax liens are automatic by statute in all cases for all tax types, even without the filing of the 668Y, okay? Dan, why does the government file the 668Y, the Notice of Federal Tax Lien? Why do they bother filing that if there's this statutory lien?
Because now it's public record, public notice that it's there. I mean, it technically, as you said, it already existed, but it's filed with the, I guess, the county records and the clerk of the court, whoever it is in your particular county or jurisdiction, whatever your counties or parishes are called, or I guess the last known address, I'm assuming, is where that gets filed?
Yeah, under court precedent, it is filed in the either the last known address for the individual taxpayer or the county state in the principal office of record if it's a business. and that counts as a filing. So yeah, you're right. The filing is there to protect the government's interest, okay, and to let other creditors know that the government has a lien, right? This gets into a whole conversation that we could spend hours on about lien priority, okay? And it's not a topic that we really have time to go into, but there are a ton of rules at the federal level and at each of the individual state levels, depending on how the state handles various different types of state liens and how any modifications that states have made to Article 9 of the Uniform Commercial Code when that state's legislature adopted it, okay? So even though it's the Uniform Commercial Code, different states do make some subtle changes. In Article 9 about lien prioritization actually has a lot is one of the most common things that state legislatures might meddle with on that Uniform Act. So lien prioritization can be handled slightly differently in each state, okay? So be aware of that. But at the end of the day, the 668Y is the public notice filing, and it's there to let other creditors, other people know that there's a tax debt, okay? It's going to come up when a lender does a search, okay? It is public record. That's how we're able to use them for marketing purposes. And the taxpayer has 30 days in order to appeal a lien filing, okay? They have a right to appeal a lien filing once they get the notice. Can everybody see my screen okay? Dan, are you still there?
Yeah, I just see you.
Can you see the slides changing?
No.
You can't?
No.
Oh, okay.
That stopped a while ago.
How about now?
Yes.
So
now I got you in the split screen with the slides.
Okay, are we all good?
Yep. So we're getting replies back, yes.
Okay.
There they are, says Renee. Renee's here.
Hey, Renee. We were talking about you earlier. Okay, I hope we're good. All right, so federal tax lien duration, okay? Dan, would you agree that the CSED is probably one of the top, it may actually be the top question we get asked about at seminars. Would you agree with that?
Yeah.
Okay.
Yeah, it's definitely one of the most common ones, yeah.
Yeah, so that's why I added this slide in here today, about half an hour ago. In general, the government has 10 years to collect on the debt, okay? So when the time that the assessment is made, on that day, the statutory lien arises, okay? The government has 10 years, 3,655 days or whatever it works out to, okay, with leap years. So what is it, 3,653 days maybe, to collect on that debt, okay? Once a 668Y is filed, it's what we call a self-releasing document. And so at the county or state level, the document has instructions that tells the county clerk to change it to a released lien after the date that's shown on the 668Y, okay? And in most cases, the IRS is required to also send out a notice of release, the 668Z, within 30 days of the CSED date passing, okay? However, there are things that extend the CSED. Just about every case you'll ever work on will have had something that extended the CSED, okay, by at least 30 days or 60 days here and there, all right? So a lot of different things can extend the CSED, all right? There's well over a dozen of them, and we don't have time to go into them. This could be a whole class by itself, I'm sure. But the most common ones that you'll see in normal practice are a bankruptcy filing, because you get the automatic stay of debt collection. And so for every day that you have that automatic stay in place from the bankruptcy court, the CSED is extended. When you file a CDP, collection due process appeal, for every day that you're waiting on that hearing, the CSED clock has stopped. Okay? When you file an offer in compromise, however long it takes the IRS to process it, could be a year, year and a half these days, the clock has stopped. If a taxpayer goes overseas and they are continuously gone for more than 6 months, the clock stops, okay? So see IRM section 5.1.19 for the exhaustive list and explanation of all these CSED extenders, okay? But these are the primary 4 ones that you'll work with, all right? The other thing I'll say about the CSED is that in limited cases, this does not happen very often, okay? But in certain cases, especially if the government is trying to make a tax evasion case, or if an examination has been referred out to the Criminal Investigation Division, the IRS on the civil side, not on the criminal side, but on the civil side, they may go through district court, sue the taxpayer in order to reduce it down to judgment, or in state court. Okay, and so once it is reduced to judgment, it's now a judgment and is handled like any other judgment. Okay, and then is subject to the judgment laws of that state. A lot of states, the judgment doesn't expire for 20 years. Okay, so that is going to linger a long, long time. Okay, so one of the things that you want to be aware of is any legal action being taken against your client on the civil side, not just being concerned about, CID referral, Criminal Investigation Division, all right? But you want to be aware of any legal action on the civil side. That is why I actually took a CE class for myself a couple weeks ago, and the person presenting it suggested that you actually look up records in Pacer or Westlaw. Those are legal search tools to see if your client has any sort of legal action. And this is one reason. The other reason for it is that's one of the questions on the 433A or B. And so if you look up in Westlaw or Pacer or your state resources to see if there might be any legal action going on that they are not telling you about, okay? So Dan, since this does come up so frequently, is there anything you think that we should add about the CSED, something we're asked a lot about?
No, I think you went through the most common questions that we typically get, and obviously we're only going into part of it because there is a lot more to it, and you probably could do at least a 1 hour's continuing education just on this. But
right.
I think that it's important to know this just because, again, this is the biggest thing that helps you. I mean, the starting point to know what avenue of case are you going to look to release a lien or to do an offer, installment agreement, PPIA? This is where you're kind of the starting point, on top of the fact that you have to know what the liability is.
Right. And Melissa, good question. I think this is what you're talking about. I just put a link to IRM 5.1.19 there in the chat box for everybody. Westlaw, W-E-S-T-L-A-W.
Yeah.
That is a commercial legal research product that lawyers use to look
it's
up
like
precedents and
like CCH research and
yeah.
RAA research. It's like those two.
Yeah, and PACER is the Public Access Court Electronic Records System. That is the federal government court search tool. It's PACER.
Can we get access to that?
Yeah, I have an account. Yeah, I use it.
Okay. Is that something you pay for?
Yeah, but it's dirt cheap, and you don't pay unless your bill hits like $5 or $10 in a quarter. And things are like, I don't know, I think they're like 25 cents a page or something like that for documents you actually pull up. So
okay.
Yeah, it's cheap. Okay.
Okay.
Yeah. So Westlaw, WESTLAW, and PACER, and then also the tools CCH and what was the other one that you said, Dan?
CCH and RAA, yeah, their RAA checkpoint and the CCH. Well, no, yeah. CCH has their own research. I forget what it's called right offhand.
Okay, cool. So yeah, check out those resources. Okay. And then also additional suggested reading about liens in general. This was updated, literally at the start of this year. They did a really good rewrite of a lot of the paragraphs in IRM 5.17.12. Chapter 17 of Part 5 is the legal reference guide for revenue officers. And so basically look at this section of the IRM, and I just put a link in the chat window. This is basically like the training that ROs go through. This is what they're taught to know about federal tax lien. So this is their legal reference, okay? It is really worth reading if you're having a hard time sleeping or you run out of magazines in the restroom. So pull that up on your phone and read away. Which brings us to our second dad joke. Dad joke number 2.
Did you say bad joke?
Ha 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 ha. What did the police officer say to the man with bees in his car? Bees. Did the cop say, "Hey, got honey?" Or, "I pulled you over because I thought you were buzzed." Get it? Buzzed. Come on. These are better than even a multiple choice question asking you to recite which section of the Internal Revenue Code stipulates the time in which a federal tax lien arises. Yes? All right.
It's a very poor attempt to see that people are still awake.
I know. Robin says you win. Can everybody see the change in my screen? I want to make sure that we're not having issues because last time it was after the polling question. So, okay. All right.
Yeah, it's up again.
All right. Let's get into the meat. Okay. So we've covered where tax liens come from, why you should care about them, the CSED, and some things that extend the CSED. Okay. So some basic foundational knowledge that you should all have about tax liens in general. Now, let's talk about the difference between a lien withdrawal and a release, okay? And this comes down to more than just the piece of paper that you're handed by the government, okay? There are very substantial differences between these two items. So first of all, remember I already said that after the date expires on the notice of federal tax lien, and I got my initials, it should be NFTL. NTFL is always just so much more natural to say or type, but that's a typo. The NFTL self-releases after the CSED that's indicated on the lien, okay? However, if the government for some reason, is going to grant you a release early. Okay, for example, you pay it off, right? If you pay it off, they have 30 days to send you a 668Z, which is the certificate of release of federal tax lien. Okay, and this is put on public notice as well to give formal public notice of the release of the statutory lien. Okay, I want to be very clear about that. The release of a lien says that you no longer owe the money. Okay? That's basically what the release says. Okay? So the 668Z is what you take to somebody to say, look, I paid it off. Okay? That is a release. The IRS is giving up their interest in collections action because they don't need to anymore, either because you paid it off, satisfied it through an offer in compromise, or the CSET expired. Okay? A withdrawal, all it does is removes the negative impact of the public record. Okay? Does everybody see the distinction? Okay? A release says you don't owe the money anymore. You're off the hook. Whereas a withdrawal simply removes the negative, black mark on your credit and on public records. Okay? That is the fundamental difference between a release and a withdrawal. Is there absolutely any question about that distinction? Seeing none. Okay. The 10916C is, and Sharonda, we will address exactly what you're asking. So hang on to the next couple slides. The statutory lien stays in place. You still owe the money. Okay? The IRS is not yielding their legal authority to pursue collection action when they do a withdrawal. Okay? All they're doing is removing the public record. Okay? There are conditions under which you can get this withdrawal. Number one is a premature filing. Okay? This is actually a pretty common one. Sometimes, especially when the IRS computer systems are the ones actually doing the lien filing, where things in the computer systems might get out of sync or something happens. The left hand's not talking to the right hand. And so a lien filing goes out in violation of IRS administrative procedures. Okay? So that's a premature filing. So anytime in the IRM where you see something where it states that the IRS will not make a notice, will not make a lien determination because of X, Y, or Z, but they file the 668Y anyway, you have grounds for a premature filing argument. Okay? There are also conditions where the tax liability is being resolved through an appropriate installment agreement. Okay? Limited conditions, and we'll talk about what those are here in a minute. Okay? But under limited conditions, you can get a withdrawal if you meet the conditions of the payment plan. Okay? Third is to facilitate collection, and I have a whole slide on that. And then fourth is one of the 9 limited taxpayer advocate case acceptance criteria. And in that case, the taxpayer advocate may intervene on the taxpayer's behalf to withdraw the lien if it is, quote, in the best interest of the taxpayer and the United States. In some circumstances, this means that the IRS is trying to avoid a PR problem. Okay? For example, soldiers serving overseas in a combat zone are supposed to be exempt from the 668Y problem, okay, even if they have a legitimate tax debt, okay? They're getting shot at. The last thing that they need to worry about is their family back home dealing with this, okay? And so the government recognizes that. The IRS says, okay, fine, serving in a combat zone, no 668Y. If it happens, guess what? People tend to get very upset, or a large group of people, not everybody, but a pretty large subset of the U.S. population gets pretty upset when the government does anything negative against, our troops, right, or their families here at home. Okay, that's kind of a big thing in this country, and rightfully so, in my opinion. So the taxpayer advocate can get involved and move the process along faster, issue a taxpayer advocate order or taxpayer assistance order to get that lien withdrawn, okay, quickly, okay? So that would be in the best interest of both the taxpayer and the United States government. That's just one example, okay? There's other examples as well. So what are administrative procedure, or what are premature filings, okay? One, like I said, violation of the IRS's own administrative procedures. This is why I really, really encourage people to read the IRM, okay? The IRM is your friend, okay? You should spend, if you're doing tax resolution work, you should spend substantial time invested in reading Part 5 of the IRM. That's why Dan and I are doing this whole, we're kind of redesigning it right now, but we're going to do this whole Inside the IRM continuing education series, okay, to highlight some of these administrative procedures, okay, where it says if taxpayer meets conditions 1, 2, and 3, do not make a determination of lien filing. Don't do it. But if the computers usually do it anyway, or if a revenue officer gets a case and goes, ooh, goody, and fires off a lien filing, because they see that one hasn't been sent, but there was some other administrative procedure that said that a lien filing should not be made, then bad on the RO, okay? And you can get that withdrawn, okay? If a taxpayer is in bankruptcy, okay, they're already in bankruptcy and they accrue a tax debt, there's a tax lien. But the filing of a lien itself, the 668Y, is a collection action. And the IRS is barred by the bankruptcy laws from taking collection action because it's a violation of the automatic stay, okay? I already talked about the combat zone issue. This is, how long have we been at war now? A third of my life. We've been operating,
14 years.
14 years, okay? So that's a lot of years with troops overseas. So even with all the drawdowns and everything like that, there's still thousands of troops in Afghanistan. Any of our 50,000 troops stationed along the Korean DMZ, that combat action is actually still technically a war zone. Because there was never a peace treaty back in the 50s, so it's technically still an active war. So it is a combat zone. So be aware of these kind of things for your clients, right? Was the lien filed when a service member was stationed in a designated combat zone? Okay, bam, premature filing. Get that thing withdrawn. MFT 35. Okay, MFT codes are IRS computer system codes for tax types. Does anybody want to take a guess or know what MFT 35 is? Anybody want to take a shot at what code 35 means? I'll give you a hint.
Take a tinkle?
I'll give you a hint. The thing it's related to is all over the news this week.
Healthcare?
Yeah. What's MFT 35? Nobody wants to make a guess?
Healthcare?
Yeah, but what about healthcare?
That you can't come after me because of the penalty, or so-called penalty, I'll call it.
Yeah. All right. So MFT 35 is the IRS computer code for the individual shared responsibility payment. Okay. The penalty for not having individual health insurance under the Affordable Care Act. And if you've read any of the Affordable Care Act, one of the most important sections for us is the individual shared responsibility section, right? And it specifically says in the law that the IRS is barred from using any of its collections enforcement mechanisms, any of them, to collect this money. Okay? That is why there are hundreds of thousands of people that owe the individual shared responsibility payment and probably don't pay it. Okay? I know that for the 2 years I've been subject to it, I would not have paid it if I wasn't an EA, because that's the one thing that the IRS is allowed to do. If you're a licensed tax professional, they can stop you from renewing or obtaining an EA license if you owe any tax. All right, so that's the only reason I bothered to pay it. And I don't know exactly how many people out there. I'm sure that Melissa says, yeah, and they bill separately. Yeah, they're not allowed to come after you for it, okay? And remember, a lien filing is a collection action. So they cannot come after you through their normal collections mechanisms in order to collect that tax. Now, Jeffrey, yes, good point. They can take your refund, okay? Okay, but is withholding your refund under the IRC technically considered a collection action? In this case, no. Okay. Keeping your refund is typically not considered a enforced collections action. Okay, whereas a lien filing, a levy, a seizure, a wage garnishment, those are all enforced collections action. Okay. So yeah, great point, Jeff. Thanks for bringing that up, because I would have forgotten to say that. So yeah, they can take your refund that you might be due in the future. So from a tax planning perspective, for your clients that are not going to have health insurance, or they don't have qualifying health insurance, like I lost my health insurance because Humana pulled out of our Washington shop market at the end of last year. So I'm without health insurance right now. And I'm going to end up owing this unless Congress does something about it. All right? But what can you do from a tax planning perspective? Okay? 2 things. This is definitely off topic, but I'll say this. 1, make sure that your taxpayer is not due a refund or otherwise due a refund, okay? Because otherwise, like Jeffrey indicated, that's going to get taken. Also, when you write the check, if they have a balance due, okay, and your client doesn't want to pay the shared responsibility payment, okay, back that number out of the total tax due, so you're only paying the tax, not that penalty. And on the memo line of the check, write for income tax only, or not including MFT 35, something to that effect on the check. So you will get a bill for it separately, but it's one of the few times that you can ever shred something from the IRS, okay? Because they have no way of forcing you to pay it. Melissa asks, can you set up an IA for that penalty? Yeah, you can. They will accept a payment plan, but you're not required to. Okay, they can't force you to pay it. All right, premature filing, LLCs. What does the IRS think of an LLC? Not much, right? Disregarded entity. So if there's a lot of other rules that go into this, but an LLC, a tax lien filed against an LLC prior to the IRS making a determination of the proper tax treatment of the LLC, and therefore who should have the lien filed against them. Okay, so for example, think about a sole proprietor, a single member LLC. Okay, who should really the lien be filed against? The individual, right? The proprietor. Well, if the IRS files the lien only in the name of the LLC, that's actually a premature filing because they didn't do their due diligence to determine that it should be the sole proprietor that should be hit. Okay. And then also, if there is a federally declared disaster area, and the disaster declaration is still in effect at the time when a lien determination is made, that's also a premature filing because the Congress's position on that was that if you're in a disaster area, you're trying to put your life back together, trying to rebuild your business, trying to rebuild your home, the lien will limit your access to credit. Okay, and so that would prevent you from getting your life back on track and recovering from the disaster. All right, so that's another grounds for premature filings. Melissa, this goes back to a question you asked a little bit ago. She asked, so when we as representatives request that a lien not be filed with a 433D, which is the form used to secure the installment agreement, it only protects from the 668Y. Correct. The statutory lien has already been established. Yes. Okay. The statutory lien was established the moment the assessment was made. Okay. So lien withdrawal as a condition of an installment agreement. In certain limited situations that you see here, you can bypass the filing of a lien and request that one not be filed, the 668Y, or you can ask for a withdrawal of an existing 668Y if you meet these criteria. So, first of all, any individual tax type, so any type of IMF module, including trust fund recovery penalty that's already been assessed. Okay? On the business side, this applies only to income taxes if the business is still operating. If the business is OOB, out of business, that's what that stands for, then other tax types, including excise taxes and payroll taxes, can also be applied to this. Okay? But if it's an operating business, excise taxes and payroll taxes, you're going to have a lien filed, and you can't, you're not going to get out of the 668Y, okay, for this condition. Also, the balance due must be $25,000 or less, okay? And I want to point out this condition did not change with the new rules that went into effect January 1st that expanded streamline criteria, okay? That bumped up streamline to 100,000 for certain limited situations. That didn't change this rule, okay? And then also you must full pay the liability under a direct debit. They take the money straight out of your checking account, direct debit installment agreement within 5 years or by the CSED, whichever is sooner, okay? So if you meet these criteria, you can request that they not file the 668Y, or if it has been filed, you can request them to issue a 10916C withdrawal. If you default on the installment agreement, all bets are off, expect a lien, okay? And Melissa asks, and 3 direct debits have been made? No, the The 3 direct debit rules is my thing. That's what I do. I wait until after 2 or 3 payments have been made before I submit the withdrawal application. Okay. So under the IRS rules, you can do it. You can submit the withdrawal request with the 433D. Okay. Let's see. Let me check the questions here. IMF, individual master file. BMF, business master file. IRS databases. Dan, any input on this?
I just got back. My computer rebooted, so so I don't really didn't catch the last little bit that you got. So
I'm talking about lien withdrawals along with a direct debit installment agreement.
Oh, well, as long as you meet the requirements, definitely go for it and do it, because you of course, charge for it, but yes, it's something that would make you a hero for for your clients to get that removed, because a lot of people just feel like they have handcuffs when there's a lien there, and if you have the ability to withdraw it, then by all means make it happen.
Yeah, and actually that reminds me of something else too, is it may be worthwhile. Let's say your client owes $30,000 in 1040 taxes, right? If you can get them to make a $5,000 payment to get it below the $25,000 threshold, you can also get the lien taken away, and so that might be worth doing. Okay, so pay down the balance a little bit if you can. All right. Withdrawal to facilitate collection. Somebody asked about this. Sharonda, you asked about this earlier. So remember, at the end of the day, the IRS is just looking to get paid. That is their ultimate objective, right? That's all they're after. They want to collect as much money as they can in as short a time period as they can. They will accept getting less money now rather than more money later in most circumstances, all right? That's kind of the mission of SBSE collections. Well, sometimes the presence of a tax lien can hamper their efforts to get paid, okay? So it obviously impacts access to credit. It can impact the ability to operate a business, right? It can interrupt factoring. It can interrupt what we were talking about last week with the asset-based financing, the merchant advance systems, okay? It can impact the ability of an individual to maintain employment, right? And the 2 most common examples that I've seen with this are in relation to security clearances. So somebody that is a government contractor or for some reason has to maintain some sort of a government security clearance to keep their job, it can be in their employment contract that if they fail a background or credit check, even a random checkup, they can lose their clearance and thus their job. Okay, it happens all the time. The good folks over at FINRA, the Financial Regulatory Authority, that issues the broker-dealer licenses and whatnot, they also do a background check and a credit check. So the assumption here, by the way, by the agency or the employer or whatever, is that you are more likely to sell secrets or to steal money from investment clients if you owe money to just about anybody, okay, especially the government, okay? So that is the theory behind these rules, okay? Also, the lien can hamper your ability to make lump sum payments. You know, if you can get access to cash by disposing of an asset or something like that, then the IRS will help you by getting rid of the lien against that asset so that you can get access to the cash so you can give the cash to the IRS. Okay? So Sharonda asks, what would be the advantage of the IRS doing a withdrawal? And then Jushun asked, then why bother to withdraw if I'm not going to apply the credit card? I paid off my mortgage and does not, okay, I'm not sure what you're talking about there actually. Why bother to withdraw if you're not going to apply for credit cards and you're not going to try to get a mortgage? This is why. Okay? This is why. Now, impact on credit reporting. This is something, we had a big conversation about this at our boot camp last year up here in Washington. And so I wanted to add a slide here to cover this. So on a credit report, okay, if there is a tax lien, it takes about 6 months or so for it to show up on a credit report. Once it shows up on a credit report, okay, and it's in the public notice section, right, then it expires, or if you pay it off and you get the release, okay, if there is a 668Z that is issued, or the time just expires, and the county records the release under the self-releasing option, it'll show up on your credit report as the lien being satisfied. Okay, so there'll be federal tax lien released. But guess what? It's still on the credit report. Do you see the problem with that? It's still on the credit report. It still happened. Okay, it still impacts your FICO score. This is another reason to go for the withdrawal. Okay, the 10916C is a document that you can send to TransUnion, Equifax, Experian, Dun & Bradstreet, Equifax Corporate, okay, saying the lien is withdrawn. Okay, the IRS is removing the impact of the public record. Okay, the credit bureaus remove the entire entry from the credit report. It's as if it didn't exist. Okay, so that is the value of a withdrawal. So if somebody needs a clean credit report in order to maintain a security clearance or a securities license or to otherwise obtain employment, okay, there's a lot of employers these days that do credit checks. Okay, you do the withdrawal. Melissa, yes. What you really want is you want the revenue officer on IRS fax cover page to send it to the credit bureaus. But you also obtain a copy and you also send it to the credit bureaus. Okay? Okay? This is the value of the withdrawal in these kind of situations. Okay? And Renee, we will get to your Facebook question from earlier. This is what the withdrawal form looks like. Okay? Pretty basic. It is always best to attach a copy of the tax lien. Either get that from the taxpayer, pull a copy from public records, get it somehow, or fill in the information. If you can't get any of that, fill in what you can from the transcripts, okay? The current status of the lien, open, released, or unknown. So you can do a withdrawal application on a lien that has already been released, okay? If it's already been released, you can request a withdrawal so that you can do this and send it to the credit bureaus, okay? Don't forget that. The reason for requesting the withdrawal, guess what? The stuff we already talked about. Prematurely filed or not in accordance with the IRS procedures. There is an installment agreement or a direct debit installment agreement, facilitation of collection, or taxpayer advocate. Okay? And then there's a block below here to fill in the space. As all of you know, I am a long-winded man. I usually attach a letter. Okay? This is a form that you should read the instructions, get to know it, and know it well. Okay? Because, like I said, probably 1 out of 15 or 20 cases you do, if you do a high volume of tax resolution work, you will fill out one of these forms. Okay? Send it directly to the revenue officer if you have a revenue officer assigned. If there is no revenue officer assigned, you send it to the Collections Advisory Group, formerly known as the Technical Services Advisory Group, and I still occasionally call it Technical Services. Reference publication 4235 for your local office. If you are in a CDP or CAP or other appeals situation, you can also file it directly with your settlement officer. Okay? You should be prepared to submit supporting documentation. Okay? So for example, if you check the box that says withdrawal will facilitate collection of the tax, and your argument is because of a security clearance, be ready to submit a copy of either the employer's policy document, the employee handbook, the security clearance guideline document, okay, stating that they need to have a clear credit report and that the existence of a federal tax lien is grounds for termination. Okay, have that in hand to submit it. And also be sure to request third-party notification. Okay, make sure that the IRS is firing off a copy to the credit bureaus. All right. And then for additional reading, IRM section 5.12.9. And that brings us to our third joke. Why doesn't Dracula have any friends? Is it because of that whole coffin thing? Or just because he's a royal pain in the neck? So take a moment and enjoy this joke for your polling question.
And this is a test of our emergency broadcast system.
Wow, we've never hit 100% voting in 17 seconds. That is a new record.
I would definitely say so. Well, I guess that means everybody's awake, especially out of 27 people.
Yeah.
Or at least they're engaged.
Yeah. I want to make sure we get through all the questions here. Okay, Sean, glad that makes sense. Melissa, yep, ask for that third-party notification. Renee, we're going to get to that. Jeff, the link for the slides is in the handout pane there, and go to webinar. Sharonda, does it make sense about why we do a withdrawal instead of a release? I want to make sure that that you understand that. Do you have any other further questions on that? Okay, cool. So the withdrawal is a tool that you're going to use you know, for fairly limited situations, right? And this rolls in, this is a good segue into what Renee was asking in our private Facebook group earlier. She was asking about a client doing I'm assuming it was a cash out refinance on their primary residence, and asking about a withdrawal. Well, here's the thing. The withdrawal is usually going to be the wrong tool to use in that situation, okay? There are advantages of the withdrawal, such as removing it from the credit report, okay? And Renee, so think about this. If you are going to do a cash out refinance, okay, their credit score is 580. Well, okay, that means they have a lot of other things wrong with their credit report, not just a federal tax lien, okay? So if their credit score is 580, good luck getting a cash out refi, depending on their LTV, loan to value ratio on the house. To get a withdrawal in that situation that will, quote, facilitate collection, okay, you're going to have to make the argument that withdrawing the federal tax lien is going to bump their credit score from 580 all the way up to whatever score it has to be for the cash out refinance, okay? I'm sure there's lenders that'll do it at 640, okay? But most of them are probably going to want at least a 680, all right? So can you demonstrate that withdrawal of the federal tax lien will facilitate collection by allowing the taxpayer's credit score to increase enough where they will qualify for the loan, and then the bank will give them the loan and then give the money to the government, okay? The answer is usually going to be no. And here's why. It's because the credit scoring algorithm is a secret, okay? There is no guarantee in any way, shape, or form that the withdrawal will actually facilitate collection by increasing the credit score and therefore making loan qualification possible, okay? That is a very rough argument to make. I have tried, by the way, and I've never gotten that through, personally. If anybody has, I'd love to hear about it, okay? So that's the challenge with doing a withdrawal in that scenario, all right? What the IRS wants to see instead is a subordination, okay? They want you to come in and say, look, the bank has already said, yes, we will do the refi as long as we can make sure that we're protected first above the federal tax lien. Okay, they want priority placement in the lien hierarchy to the federal tax lien. Okay, if you're trying to do a withdrawal based on a hope and a prayer that the credit scores will go up enough to then qualify, the IRS is going to be like, nah, don't think so. We're not withdrawing the lien for that. Yeah, so they already have to have credit that's good enough even with the lien being present, okay? If they have a 580, withdrawing the federal tax lien is not going to give them a 100-point bump. It's not going to happen. You know, they might see a 20 or 30-point bump, but not 100. I mean, they're not even going to get to 640 unless they're also simultaneously doing a bunch of other credit repair stuff, okay?
Jason, would it help if, or would it matter that, let's say, 580 to 600 or 620 might give them a better interest rate that might help improve their payment? Just from a cash flow standpoint?
Yeah, so so improvement of cash flow, that's going to be a sketchy one as well. Good luck on that. I don't think you're going to get that one either. Because there's still no guarantee, right?
Right. Well, I mean, obviously the tax lien is one aspect of it. There's other things that they have to try and do to improve a credit score, with enough points.
Yeah.
Not to mention trying to make payments on time and, get rid of other open debt and those types of things. But,
yeah,
I mean, at least it could help it wouldn't hurt to make the argument, I would say.
Yeah. Well, like Jeff Snyder just threw in here, the rate will not go down that much for 20 to 30 points. And that's true. When I bought this house back in December, my credit keeps going up a little bit every month, as I get further away from my past bankruptcy and my past problems. But the rate difference, if I had actually managed to get up to a 700, I was like 5 or 6 points away, and getting to a 700 would have dropped my rate by by an eighth. Okay, but that would have only lowered my payment literally like $15 or something. So, yeah.
Okay.
Yeah, exactly, Danielle. Exactly. That argument was successful for me, but the improvement of cash flow was several $100s a month. It was the difference between non-collectible and $350 a month. Okay, exactly. You're spot on. Substantial is the key word. Yeah.
Well, that goes to the example that I've talked to you about. Is I have a client / friend of mine that for him to go from renting to buying a house, he could go from paying, I think he's paying $2,200 a month to $1,400 a month, and that would free up the cash. Chug, Jason, chug. You need a little sugar infused.
I was just seeing if you were paying attention.
Yeah.
Yeah, exactly. The going from renting to buying scenario. Exactly. So, Renee, the withdrawal is not likely to occur. Is it impossible? No. But I wouldn't waste the 2 months chasing it. I would do this instead. Okay? And that is the subordination. So the challenge for you then becomes finding a subprime mortgage lender that's still in business in 2017 that will lend on that 580 credit score. Okay? That then becomes the challenge, especially at an affordable interest rate. Okay? Oh, they're out there. They do exist. You're probably going to want to find what's called a portfolio lender. And now we're going way off topic. A portfolio lender, Renee says, I have 3 mortgage lenders and they all denied. If they're brokers, you can't do this through a broker. You need to find what's called a portfolio lender. And that is usually a local mom and pop bank or credit union that doesn't sell the loan on the secondary market, meaning they underwrite the loan themselves and they keep the loan and they service it themselves for the life of the loan. They don't sell the loan or the servicing. What that means is that the loan then does not have to meet Fannie or Freddie underwriting guidelines, because pretty much anything sold on the secondary market has to meet, VA, FHA, USDA, Fannie Mae, or Freddie Mac guidelines to be saleable on the secondary mortgage market. Okay, so you need to find a portfolio lender that will keep the loan in-house, and they will be able to work with you. My advice would be to check with credit unions. Okay, credit unions are much more likely to do that, or also check with small regional banks. Okay, like out here in where I live, a peninsula of 250,000 people spread out over an area bigger than the city of Seattle. which has almost 3 million people. We have a small regional bank called Kitsap Bank, and they do portfolio loans. Right now they're at like 5.5%, so substantially higher than a saleable loan, but they will do them. Okay, so, but even in that situation, you're still going to have to go through a lien subordination because the bank is going to require being in first position. Okay, and that is the purpose of a subordination. This is a process where the IRS agrees to let somebody else take priority position over them. You are subordinating, making the federal tax lien subordinate or junior to something else. Okay? And yeah, you can do this in ACS. Okay? Understand, though, that a subordination does not release or withdraw the lien. It is neither. Okay? Both subordinations and discharges are applicable to one asset. One. Okay? So you use Form 14134, and this is, and the people that process these, the people you file them with and that you process them with, okay, whether it's ACS or an RO, the people that process these are property and liquidation specialists, PALS people. These are people that are finance majors and accountants. There are people, right? They're not collections people. They're not associated with collections or exam. They're a whole other unit, right? They're part of that advisory services group. Okay, that's who you actually send this to, whether it's an ACS or with an RO. But if they have an RO, you have to talk to the RO about this. Okay. It applies to one piece of collateral, and you have to identify the asset and the lender, and you have to cite the specific code section that you're applying under. And there's about a 30 to 45 day processing time for both these and discharges. All right. These are the code sections. So this is section 6325 of the code. And subsections D1, D2, and D3. All right. These are the ones that you're going to look at. And here is basically what they mean. And this is my summation. Under D1, the IRS is going to get paid today. Okay? So if you're doing a cash out refinance on a house, you're doing a D1. Okay? Because the IRS is getting the cash. Under D2, it's some sort of scenario where the IRS is going to get money later. They're not going to see anything now, but they'll get something later. Example of that related to what Danielle was talking about. Let's say somebody has a house and they got their loan during the Carter administration. Okay? For anybody that's on the webinar that's younger than me, you may not know what that entails. Okay? During the late 70s and 80, 81, 82, mortgage interest rates were in the high teens. Okay? So let's say you have a client. I doubt that there's anybody like this that exists in the country, but we'll make somebody up. Let's say there's somebody that got their mortgage, in 1981 at 15% interest rate. Okay? Their house is now appreciated. They never refied. Let's say it was a 40-year loan. I don't know. We're making all this up. But they have a really high interest rate and a really high payment. Then you do what Danielle did, right? She did it through a withdrawal, but we could also do it on an asset for a subordination. We're not going to pull any cash out, but if this person can refinance from 15% down to 4%, What's that going to do to their mortgage payment? Okay? That's going to open up hundreds and hundreds and hundreds of dollars a month to go towards an installment agreement, which means that the IRS will get more money later. That is a D2 scenario. Okay? And then D3 we don't talk about because that's on farm property, and that's something I don't know anything about. But if it's on farm property, do not use the 14134. Refer to publication 1153. Okay. A quick look at the form 14134. We're not going to go through the whole thing. A lot of it's pretty self-explanatory. When I first started doing this kind of work, this form did not exist. Back in 08 and 09, when I was doing these, we didn't have a form. You actually had to write up a letter with all the same information. But in 2010, they finally gave us a form. So all your standard identifying information, who the property owner is, representative information. They want to know who the lender is. They want to know how much of any existing loan, amount of new loan, and how much the government's going to get, all right, if you're doing D1. If you're doing D2, you'll check that box, and you'll need to attach a statement explaining why and how much by the U.S. government's collection potential is increasing. Okay? So you need to attach a statement saying that refinance to a much lower interest rate will, free up $500 a month off the mortgage payment, which the taxpayer will pay to the IRS over the remaining, 20 months of the collection statute, resulting in an additional $10,000 collected by the government. Okay? Then a description of the property. Also attach deeds, titles, other information like that. They want to know how much the property is worth and how you arrived at the value of the property. Okay? Note that a professional formal appraisal is not required. Okay? It is not uncommon to pull Kelley Blue Book, eBay completed auction prices, and that kind of stuff, and I'll attach those. What I suggest for real property is that you don't pay the $700 for an appraisal, okay? But instead, you go to a real estate agent, a disinterested third party, okay? And you ask them to do what's called a BPO, broker price opinion. It's the exact same thing as a CMA, comparative market analysis. Same thing, different term, okay? Go to a realtor, ask him or her to do a BPO. It'll cost you 80 to 100 bucks, maybe 150 in some more expensive markets, okay? The IRS will accept that BPO from the realtor as a valuation, okay? A copy of the federal tax lien, attach a copy of the new loan agreement, and describe how the government is going to benefit from the subordination, and then a copy of any other encumbrances, okay? Closing statement such as a HUD-1, and any additional information, and then do note that this is signed under penalty of perjury. A county assessor report, Frankie? Yes. And that's actually one of the boxes. You could just county evaluation of property. However, this requires that you have an understanding of how the local county makes their tax assessment decisions. Not every county uses fair market value. Not every county does annual updates. Okay? So you have to understand how that works and understand whether the valuation of the property may be too high or too low from reality to suit your purposes. Okay, so you have to take that kind of stuff into consideration. All right. And then Frankie also asked, OIC has a balloon payment at the end via cash out refi of the house. Yeah, so if you're on an offer and compromise that has I assume you have a collateral agreement attached to it, and there's going to be a balloon payment. Well, the federal tax lien doesn't get removed until after the entire offer and compromise agreement is settled, right? And so, yeah, you're still going to have to do a subordination. Fortunately, though, in those situations, those get processed a lot faster because they're basically rubber stamped by the PALS people because they understand what's going on with those. So you should definitely get those back within under the 30-day window on those. But yeah, you still have to do the process. Okay. And the lender is going to require that, by the way. Okay. New purchases. This is a question that comes up sometimes. Does the existence and therefore priority of a federal tax lien in any way prevent or prohibit a bank from lending you money to purchase an asset? Okay. So this delves into some of the prioritization rules under state laws and the UCC, right? So, and this is not a new issue. In fact, it is a very old issue. And the answer is no. There is nothing that would prohibit a lender from lending you money to acquire an asset, okay? And here's the thing. The subordination is not required, okay? This came out in 1968, and it has never been updated, ever. As a matter of fact, publication 785 from 2005, I think is when this was, yeah, 2005, actually addresses this, okay? In the event of purchase money security interests, which are detailed under the UCC, or purchase money mortgages, which are usually governed by state law, as long as the creation of that is all hunky-dory under state law, and that security interest is recorded also in accordance with state law properly, then a subordination certificate is not required, and if you apply for it, they won't give it to you anyway, okay? So Revenue Ruling 6857 basically says that if some lender is willing to give you a loan to buy a new boat, buy a new plane, buy a new house, even though you have a federal tax lien in place, the government isn't going to interfere, okay? And here's the key language. This is based upon the concept that the taxpayer has acquired property or a right to property only to the extent that the value of the whole property exceeds the amount of the security interest from the lender. All right? So if you're buying a house for $200,000, or yeah, you're buying a house for $200,000, you get a $200,000 loan, okay? But the house is actually worth $300,000. What is the value of the government's interest in the property? $100,000, okay? Because that's the amount of your equity in the house, okay? So this is an important concept. Your clients can still go out and buy stuff on new credit, and the government's not going to intervene, and no subordination is required Yes, good luck finding the bank that will give you the loan, but they are out there, okay? So that's why I bring this up. Polling question time, and we're actually going to do 2 of them because I'm behind. What's the best reason to move to Switzerland? Oh, there are so many. The Alps are beautiful. The people are amazing. You can pay $700 a semester to attend, EPFL, one of the top engineering schools in the world. They're in Lausanne. There's great chocolate. All these wonderful things. So I don't know what your reason is, but I'll tell you, the flag really is a big plus.
You tell me.
I actually love this one.
Yeah, it's actually not a half bad one. I've never really thought about it that way.
I wonder if there's anybody that doesn't get the joke. If you don't get the joke, let me pull up Wikipedia.
I got the joke the first time you did it, but it took me a little bit. I was a little slow on that one.
Yeah, that's the Swiss flag. Renee says it took me a while. All right, 88%. We got a couple of you that still need to vote. Wake up, folks. Wake up. 92%. Come on. Come on. We can get there.
Well, you've got a fan in Thomas. He likes that.
Ever. Nice. All right, I'm closing that one, and I'm going to throw up the next one. I like this one, too. What's the difference between tuna and a piano? Everything. Nothing. The weird thing in between. Or you can tune a piano, but you can't piano a tuna.
Yeah, but you can tune a fish.
Dan. Hey, Dan.
Yeah.
I'm 12.
Yeah. No, you didn't have to tell me that one.
Thomas says, worst question ever.
Well, there you go. You hit the top and the bottom all in the same span of 2 minutes.
All right. So I'm going to leave the question up for another little bit so that everybody can answer, but I do want to get on to discharges. Okay. The lien discharges are so very similar to subordinations. The form is almost identical. Okay. The process is almost identical. The code citations that you have to reference are almost identical. Okay. But here's the difference. A subordination is used to make a federal tax lien junior to other new financing. Okay? Whereas a discharge removes a single asset out from under the umbrella of the tax lien entirely. Okay? That's the difference. Does that make sense? Does anybody have any question on the difference between a subordination and a discharge? Seeing none. Okay, so a certificate of discharge applies to a specific asset. Okay, a building, a piece of land, a house, a car, a truck, a trailer, a backhoe, mineral rights, logging rights, rights to oil lease payments. Okay, all those are assets, right? Royalties. Okay, rights to royalties. That's an asset, right? Intellectual property. It's an asset. Okay, all covered. Stephen, yeah, collectibles. Okay. Your collection of Spider-Man comic books, Stephen, is an asset that could be covered by a federal tax lien. And you can't sell those comic books without doing a discharge. Okay? you use form 14135, and real quickly I'll put the form up here. If you glance through the form really, really fast, it looks identical to the 14134 because it basically is. Okay? They only changed a few things. What's missing? What's missing? The line here about refinancing and the new loan amount. All right? Notice instead it says proposed sales price. So they want to know the sales price and how much are we going to get. Okay? That's what the form says. You have to describe the asset, the sale details, what the government's going to get out of it. Okay? And this applies to most things, but remember on the subordination, if it was farm property, you don't deal with the 14134. You have a different process. Well, on a discharge, if it's an estate tax, that requires special processing. Jushun, so once subordination is approved, it will apply to all the properties? No. Subordination also applies to only one asset, but you're keeping the asset and you're applying financing to it. On a discharge, you're getting rid of the asset. But on both a subordination and a discharge, it applies to one asset. These are the lien discharge code sections. Okay? B1. The IRS likes to see that if you are going to sell an asset, that you have remaining equity in assets equal to at least 2 times the tax liability. Okay? If that's the case, then you kind of get, it goes by a little faster, you know, it shows that you still have enough equity to ultimately satisfy the liability. These get rubber stamped, right? Because there's still equity under your hat to pay it. B2A is if the IRS is going to receive an amount equal to their interest in the house or in the asset up front. So if you're going to sell a house and the IRS's interest in the house is $5,000, they're going to get the $5,000. Okay? And then they're going to actually get that up front. B2B, you demonstrate that the value of the U.S. interest is 0. You owe $100,000 on a house. House is worth $50,000. You know, and you're going to sell it for, you know, for the $50,000. Nobody's getting anything. You ain't getting nothing. Government has 0 interest as well. All right? And so maybe you're just selling it to free up the cash flow. B3, the sale proceeds are escrowed and the IRS gets their share afterwards. Okay? Who escrows the money in a real estate transaction? Okay? Usually, like out here, we usually do it with the title company that's doing the closing. They escrow the money. Okay? You might have a closing attorney that's escrowing the funds depending on how your state handles property transactions. Okay? B4 is the buyer of the property is putting up a bond equal to the amount of the government's interest in the property in order to facilitate the transaction. Okay? And we already looked at the form. All right. So on both subordinations and discharges, just some general tips. Again, they are asset specific. They both apply to one asset. You file directly with the advisory group, and the PAL, the property and liquidation specialist, they're looking at the math. If the math makes sense for the government, or the value of the asset is 0 in the eyes of what the government's going to get out of it, these will fly right through, okay? And also require that you may have to get an appraisal. For real property, just get a BPO from a realtor, I've never had a BPO denied as legitimate, okay? And it's much cheaper than an appraisal on real property. And the vast majority of these that I've done, the number one thing by far is houses, okay? The number two thing is probably going to be cars. And in my number three one that I've done them on is boats, okay? And I've also done a few airplanes. But it's usually going to be real property in most of these situations. All right. I did want to discuss this, but I guess I added too much material because we don't actually have time to discuss this. Well, I guess we did discuss this earlier. Renee, did you get everything that you needed answered on your cash out refi situation? Okay, cool. Now, just a quick question. Which tool are we going to use to sell a boat that has no equity in it? Let's say we have a boat that's worth $15,000, but it's got a $20,000 loan on it. Am I going to do a withdrawal, release, subordination, or discharge?
This is the interactive portion of your discussion today.
Yeah, exactly. It's a discharge. Okay? Because we're going to sell it. Okay? Melissa says, I'm a little confused over subordination versus discharge. The easiest way to look at it is subordination, you're keeping the asset and bringing in financing or refinancing. Discharge, you're selling the asset. That's the fundamental difference. Okay?
So what about Renee's question where she says, why sell it if no equity?
That was actually just, yeah, I was just going to ask that. Why would we sell the boat with no equity? You know, is the IRS going to get a cut?
No.
So.
Nothing to get.
Okay, Dan, you live in Florida. I live in the Seattle area. Both are huge boating communities, right?
Correct.
What is one of the biggest expenses of owning a boat?
The marina.
Bingo. Slip fees, okay? Typical slip fee around here is, you know, for a 32 to 36 foot boat, you're looking at $400 a month. And that's where I live. Over in Seattle, like anywhere along the waterfront downtown Seattle, for a 30-something foot boat, you might be looking at $600 or $700 a month for a slip. That's just a monthly payment to store the stupid thing. Okay, it is not. You know, following the financial crash in 2008, it became very, very common for people to just abandon their boats. Okay, and the marina will have a I guess it's, I don't know exactly what it is, but I guess it's like a mechanics lien kind of thing. The marina will have a lien against the boat if you don't make your slip payment. So people just stop paying it, and they'll let the marina take the boat, because then what happens once once they sell the boat at auction, whatever they get out of it goes first against the slip fees, and then the rest goes to whoever's next in line, which is usually going to be the lender. Okay, and then obviously the boat owner, the original owner, is still on hook for whatever the balance of the loan was, but it's usually a lot cheaper than keeping the boat and paying that slip fee. Robin says, yeah, $700 a month in Michigan for a summer slip. Okay, that's why. Same thing with airplanes. I used to own a Cessna 150 many, many moons ago. I typically paid about $200, $250 a month just to keep it stored out in the open, in the rain, on the tarmac, tied down. Okay, I call it a tie-down fee. So anybody that has toys like this, you know, I just bought an RV. You know, how much does it cost a month to store an RV at a storage unit place? Right now, I just have it sitting out on the street in front of my house. Okay? Eventually, the neighbors are going to complain. I'm going to have to put it in storage.
You're bringing down the home values, Jason.
I am. Well, my neighbor 2 doors down has 3 boats out in front of the house, so I'm not too worried about it.
Okay.
Very funny, Melissa. Very funny. These are tools to facilitate resolution. Make sure that your client understands the purpose, and don't be afraid to explore outside the box options that apply these tools. Okay? Doing multiple subordinations, doing subordination for cash out refinance, then a discharge to sell the asset 6 months later. Don't be afraid to stack these tools. Okay? So, and then I did want to point out, these are completely unrelated. Have nothing to do with what we've been talking about, but they're important to mention in case you didn't get the memo from the IRS. Effective March 27th, so next Monday, all right? So after the weekend, any offer and compromises received by the OIC processing units will be returned unprocessed if there is even a single unfiled return. What they used to do is send you a letter from the process examiner saying, hey, you didn't file the returns. We're going to give you an opportunity to file the return. Not anymore. They're just going to send it back. Why? To reduce their inventory in-house. Okay, so it's not on the books. However, they're going to keep it whatever initial deposit you make and apply it to the tax liability. They will not cash the check for the application fee, however. Also, on Monday, check this page, okay? On Monday, check this page. I'll put it in the chat window. These numbers for collection financial standards are changing on Monday. Okay? Danielle.
Hopefully upward.
I wouldn't count on it. I would not be surprised if they went down again. Okay? But we'll see. We shall see. So yeah, those two things are pretty big. Pretty big. So last polling question. Although we're well over time, I'll use the 5 out of 6 rule for issuing CPE credit. Did you hear about the guy who jumped off a bridge in Paris? He was insane. The River Seine that runs through Paris.
Ba-dum-bum.
2 geography jokes in a row. All right, folks. That's all I got for you. Pearl is looking at me like, yo, where my food? Oh, am I still on camera?
No.
Oh. So I will close this.
There you are.
Nobody has ever met Pearl. Hi. 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 That's you. Can you see yourself? This is my baby girl. This is my baby girl.
She seems to not care at all. She's like, what are you doing?
Yeah, she doesn't like being picked up. Oh. She's like, put me down, you stupid idiot.
Right, yeah.
Yo, she's such a good doggy. Yeah, such a good doggy. Mwah. All right. So that's Pearl. The funny thing is, here in the new house, I have hardwood floors throughout the entire house, and dogs and hardwood floors are the most amusing thing in the world. So.
Yes, they are. We have them in our house too.
Yeah. She loves running in a circle between the kitchen and the living room, and it's just her little paws, you know, trying to get traction. Oh, you're a good dog. All right. Any questions on? And again, the biggest thing I want to make sure everybody understands, in particular, is the application of discharge and subordination, the difference between the two, and then also the difference between release and withdrawal. I think those are the two most important things for you to get out of today. So if you have any possible questions on that, I want to get those answered. Any comment on NREM liens that survive bankruptcy? What do you mean by NREM, Clint? Not sure what you mean. They sell doggy booties? Really? I didn't know that.
Wouldn't surprise me.
Yeah, you know what?
Sell everything else.
I
just saw on the news that they have a service you can get your dog cloned for $100,000.
Oh, geez. Statutory lien. Any comment on remaining? Oh, I mean, if there is a tax liability that survives bankruptcy, then yeah, the statutory lien still exists. And people, there's a misconception that you can't flush tax debt in bankruptcy. There's a three-pronged test, and you actually can flush income taxes in bankruptcy as long as you meet the test. But if there's any tax debt that is not flushable in the 7 or 13 or 11, then yeah, there's still a statutory tax lien after the bankruptcy. Anna says, I haven't received credit from the 2 prior seminars. Yeah, it's going to be 1 certificate of completion for all 3 level 2 webinars. Thanks, Danielle. I'll take a look at that. Any other questions? Going once. Going twice. Going thrice. Going quadrice. Gone. Have a good day, everybody. Thanks for being on, and thanks for your participation.
Later, Jason.
Thanks for being here, man. Appreciate it.
No problem.